In this week's double episode, you're going to hear what two top financial experts had to say at our Orlando Investor Conference about the market outlook. That was at the end of October, and with the benefit of hindsight, we know they were dead right. In fact, the major averages are enjoying their strongest rally since 2021. In these segments, you'll hear why they expected this, what they see happening next, and how you can profit. Hi there, I'm Mike Larson, Editor-in-Chief with MoneyShow, and I'm coming to you from the Orlando MoneyShow Traders Expo with Sam Stovall, Chief Investment Strategist of CFRA Research. Sam, how are you?
Good to be here, Mike.
I'm glad to have this chance to speak to you again, especially I'm hoping for a little bit of optimism as we head into the end of the year, and I feel like that might be a message you're about to share, so I'll let you just take the floor and tell me what you think about these markets.
Absolutely. Well, I always like to say that when life gives you lemons, make whiskey sours.
That sounds delicious.
And so one of the things that I look to is history, and I see what does history tell us may be the case, knowing full well that history is a guide and not gospel. And then I overlay history with what is happening currently in the economic environment, geopolitical environment, etc., to see whether history will repeat or, like the singer of the national anthem, forget the words.
There you go.
So, if you're looking for a good reason to be positive, it's look to the presidential cycle. We are in the fourth quarter of the pre-election year for a first-term president. Since World War II, the market has posted a total return of close to 6% in this fourth quarter and has risen 100% of the time. Now, obviously, that's not a guarantee, but it's certainly a comforting statistic.
Sure. Let's talk about some of the things that people are worried about these days, right? I mean, it looked like the first half of the year, everything was pretty much going great. We could have used a little more market breadth, but it was a strong situation. Then July, August, and September haven't been so good to us. So interest rates, how big of a concern, a headache is that in your mind going forward as we roll into the new year?
Well, I think that the reason that the market peaked on July 31st of this year is because euphoria got out of hand. The Nasdaq was trading at 26% above its 200-day moving average. I mean, even General Patton never got that far ahead of his supply lines. So we needed to either correct in price or time, and obviously we have corrected in price. Through Friday, the 27th of October, the S&P finally broke below that minus 10% threshold, so we're now officially in a correction, even though it's only down 10.3%. But I think interest rates are the primary reason why the market is so nervous. Primarily because interest rates really drive intrinsic value going forward based on the discounting mechanism of interest rates. But when you really don't know how high the 10-year yield is likely to go, I think that's the real worry. Going back to the 1950s, essentially what you find is that the 2-year note and the 10-year note, their yields tend to peak at the same time, with the 2-year being a little more advanced than the 10-year. So if you start to see a decline in the 2-year, then the feeling is, okay, well then maybe we've hit our apex in terms of the 10-year note, which right now is around 5%.
Now, if we shift a little bit to geopolitics, we all know this is a great human tragedy, unfortunate that things is going on. I mean, as markets, as investors, they do tend to look at what that means for the economy, what that means for markets. So what are your thoughts? What has your research shown in terms of events like what's happening in the Middle East? How does that impact markets?
Well, it does impact markets, at least in the near term. Looking at selected military shocks since World War II, which include the 3-day war, the Yom Kippur War, Iraq invading Kuwait, the 9/11 bombings, etc. What you find is that the first day, the first week, the first month after these events, the market gained only 1 out of every 3 times. So typically the market is shaken by that news. Yet 60, 90 plus days afterwards, what we find is that no, the market pretty much rights itself and realizes that it's going to be more of a localized event. So I think what's happening right now in Israel, Gaza Strip, etc., it's too early to know, because one of the worries is, will it broaden and become a much larger regional conflict, or will it end up expanding even beyond the Middle East? So that is a worry, because we had the Yom Kippur War in October of 1973 that exacerbated a bear market of 73 to 75, Also, the Iraq invading Kuwait exacerbated the recession and the bear market of 1990. So who knows what's going to happen this time around? But generally, longer term, the market recovers.
Got it. Okay. The other big thing that's out there on people's minds, recession risk. I mean, it's odd. This time a year ago, Bloomberg had a headline. It's like, we see a 100% chance of recession based on our model. And of course, we just got GDP that was very strong. So where do you come down on that side of things? Do you see a significant recession risk? Do you think it's overblown?
Well, we're of the mindset that we will hit economic softness starting in the fourth quarter of this year. That even though the GDP was up 4.9% in the third quarter, first off, remember, that's not a year-over-year number, but is an annualized number based on a quarter, the third quarter versus second quarter. Based on that, we're only looking for 1% or less growth in fourth quarter of this year, first half of next year. So if things get out of hand, then that 1% growth could end up becoming negative. The real arbiter, however, is the Business Cycle Dating Committee of the National Bureau of Economic Research. And they decided that the 2 quarters of GDP decline in 2022 was not enough to say that we're in a recession, even though Arthur Okun, who was one of the economic advisors to Presidents Kennedy and Johnson, came up with that rule of thumb that said 2 successive quarters of GDP decline signal a recession. So employment as well as the economy really have surprised economists. So will those data points still get credit if we fall into a recession next year or the year after? It seems to be a little bit late.
Yeah, I got you. Other question, earnings, the earnings outlook here and the earnings results we've seen. I mean, what are you seeing as we get towards the tail end of the Q3 cycle and roll into Q4 next year? What is your work showing there?
In terms of earnings,
yes, correct.
We're looking for earnings to actually start to pick up. The interesting thing is we just finished 3 quarters of earnings declines. That was fourth quarter and then the first 2 quarters of 2023. We entered the third quarter reporting period with a decline of 1.5%. But interesting that in 54 of the last 56 quarters, the actual results have exceeded end of quarter estimates by an average of about 4 percentage points. So history basically said, don't be surprised if we end up with a positive year-on-year change for the third quarter, and that's exactly where we stand right now. We're looking for about a 6.5% gain in earnings in Q4, and then a 12% advance in 2024, with all 11 sectors posting positive earnings results, and 5 of those 11 sectors posting double-digit gains. So
that sounds pretty positive, right?
It is, and it's also the usual suspects: communication services, consumer discretionary, tech, industrials, et cetera, that are expected to show those double-digit gains, whereas the more defensive sectors still likely to be positive, but in the single-digit area.
And that was going to be where I was going to pivot next, sector-wise, in terms of where you see the most potential to outperform versus the least, and kind of what your work is showing there.
Well, I guess the real question is, how far down do we think that this decline could go? The interesting thing is that we typically see a pop before a drop, meaning we had the bear market bottom on October 12th. We rose 28% through July 31, and now we're down 10.3%, which interestingly is the exact average decline that we have experienced after going into a new bull market since World War II. The real question is, will it stop at minus 10.3%? But every bull market since 1949 has gone on to set a new all-time high. And so as a result, or recoup what it lost in the prior bear market, we had to wait till 54 to hit a brand new all-time high. But every bull market since 49 recouped everything that it lost in the prior bear market. This one we recouped 83%, so we're close, but it's not like the others.
Got it, okay. One last question I guess I would have, and I like to ask most of the guests this: what could go better than expected, I guess, in your scenario? What things do you think could work out better for investors versus what are some of the things that worry you, keep you up at night, as maybe, on that base case scenario not holding?
Well, I think, what keeps me up at night, it's Putin, because he snores. No, just kidding. But geopolitical things concern me, whether it's Russia, whether it's China, Iran, the expanding of the tensions in the Middle East, et cetera. What might that do to the Straits of Hormuz, energy prices, et cetera? And so that could be a big challenge. What also keeps us up is something we cannot forecast, and that is just how high will the 10-year note go. The average since April of 1953 is 5.75%. So, but usually the 2-year ends up peaking a shade before the 10-year and at about the same level. So I think that for this short-term go-round, we could see the 10-year note close above the 5% level, but not above 5.2, which I think will end up being encouraging. So if we get yields coming down, if we have earnings continue to do well, employment remain firm, but we see the downward trajectory in inflation, and traditionally the S&P has risen an average of 13% in the 9 months after the Fed stopped raising rates, with all sizes, sectors, styles posting advances. I think we could see a similar positive move should the market come to the conclusion that the Fed is done.
Now, let's hear from another optimist who has an inside look at unusual market activity. You'll love what he has to say. I'm here with Jason Bodner, co-founder of Map Signals. How are you, Jason?
Hey, it's great to be here.
Glad you could be here. So I follow the work your firm does, but for anybody who might be watching this and isn't familiar with Map Signals, why don't you talk a little bit about what it is your company does?
Sure. So Map Signals is a quantitative analysis firm for stocks. We do quantitative analysis, for lack of a better word, on stocks, and really our main unique angle is looking at unusual institutional accumulation or distribution. That's a really wordy way of saying really unusual buying and selling that most people can't see.
Okay, all right. So what is it that you use to track that? How does your methodology work? What is it that you guys have been able to build that allows you to follow that kind of stuff?
Sure. So I spent years on Wall Street. It was my job to hide large trades for really large people. So in essence, we know what to look for, and we're looking for unusual price action, whether it's breaking out or breaking down. We're looking for unusual volume, unusual volatility, and those are just some of the metrics and the technicals. And we have proprietary algorithms that look to identify when huge investors are out there trying to keep their trades quiet, which is exactly what they used to pay me to do.
Got it. And I know that your main indicator, one of them is the Big Money Index. Can you talk a little bit about BMI? How does it work?
Yeah, absolutely. It can feel a little overwhelming when you try and break it down, but it's very simple. Basically, it is a moving average of unusual buying and selling. So think about it, money flowing in and out of a market, but kind of through X-ray glasses. You can't see that trading if just looking at a chart. And basically what it tells us is there are periods where things are extremely overheated, markets get overbought, and we can expect a market pullback. And then there are really unique times like right now where the markets go oversold, and it has been an incredibly bullish indicator over time.
Got it. And I definitely want to get to your current market outlook and what you're seeing. Before I do, though, you also, in addition to just the overall market, it's also sector focus and individual stocks, correct? You publish numbers for pretty much everything that trades? Or?
Yeah, absolutely. So our universe is looking at over 6,000 U.S. listed stocks and ADRs every single day. We also look at ETFs. We break down our analysis by sector, the 11 major sectors, and we're also looking at market caps, slicing out how big a company is and what type of action it's seeing in terms of buying and selling. And then we are also looking at ETFs as well, which can be used sort of as a macro yardstick, if you have bond ETFs, gold ETFs, things like that. So yeah, we do sectors, market caps, and ETFs.
So I think we've got a pretty good understanding of how your methodology works. So the important thing for people watching, as we record this at the end of October, what are you seeing in this market? What are you seeing from your data?
Well, we're seeing from two different lenses. The emotional lens, it stinks, right? The market's under a lot of pressure. There's a lot of fear out there. Everybody's worried about interest rates, war, what's to come in the future, all that stuff. What we actually see is opportunity. And as I just mentioned earlier, our big money index has gone oversold. Now, what oversold means 25% of all of our daily signals or less are buys. So when it falls below that level, it says, hey, the market's oversold, expect a big reversion. And it's so strong, in fact, that since 2016, where the BMI is right now below 19%, it happened 18 times since 2016. 100% of the time, the markets were higher 1 month, 3 month, 6 month, 9 month, and 12 month with phenomenal forward returns. And if you go back even further to 1990, you see a similar return profile. Not quite as strong, but it just highlights that there's a really good chance that we're going to rally from here.
Got it. So it's not just a either-or indicator. It also can be a magnitude, like how deeply oversold, for example.
Yeah, the further we get to zero, the closer we are to the bottom. And it's been under a lot of pressure. In fact, we haven't seen levels like this since April of 2022. And amongst those times in 2016, a lot of them were in 2008. I don't think we're in 2008-like conditions right now, but yeah, to your point, there is a magnitude.
And what do you see from a sector-based standpoint? I mean, okay, so we've talked a little bit about what the BMI may be saying about the broad averages. Are there certain sectors that look, more attractive here, less? Where, what is your data showing there?
So right now, our data is showing that energy is the strongest and the most resilient to market pressure. It's led by oil and gas exploration companies. Now, another resilient sector has been technology until very recently. Large cap tech has been hanging in there, propping the market up, and now all of a sudden last week we started to see some selling. So selling across all remaining sectors, discretionary, materials, financials, real estate, utilities, communications, all of those staples. Now, what's interesting about that is that's kind of what capitulation looks like. Where kind of when everybody's throwing out the baby with the bathwater, the indications are oversold, fear is at its highest. This time it's different. It's usually not, is in our experience.
No, I hear you. It's funny because I remember my sort of own way I looked at the markets. I was looking at how boring sectors, the utilities, REITs, things like that, a couple years ago were outshining the more aggressive stuff, and then it sort of flipped a script and it was the more aggressive things that we're doing. From what you're describing, it seems like it's still kind of in that aggressive profile, right? If you have energy leading, if you have tech that up until very recently, I mean, is that how would you characterize, you look at your screen and say, okay, this looks like a great market, mediocre market, terrible market?
Personally, I think it's a great opportunity right now to find highly fundamentally ranked stocks, according to our metrics, that are being punished unfairly with the market. Now, to your point, a couple of weeks ago, utilities went deeply oversold. You can see it in our data, a bunch of red. It just looks really ugly. And we put out some statistics saying utilities are oversold, expect a big rally. XLU, I think, is up 4.5% since then. So we can kind of use these extreme points to pinpoint market pivot points for not just the overall market, but to your point, the sectors. And we're seeing that in other sectors as well. So I think it's a target-rich opportunity. Last thing I will add is, historically speaking, October through December since 1990 are the strongest months of the year. And 75% of the time, that 3-month period is positive on average. So we have a seasonality component. There are a lot of things lining up where, even though it looks dark, there's something positive around.
Let's hope that the whole "it's darkest before the dawn" approach works here, right?
I'm an optimist.
There you go. Perfect. I love it. Any thoughts about longer term? I mean, I don't know historically how long your signals would apply for. I mean, if you put your sort of fortune teller's hat on, you look ahead to 2024. I mean, is there anything from the data you can glean now that kind of articulates what you're thinking about next year?
Next year, yeah. So, I mean, if we're looking statistically speaking, which is kind of MapSignal's specialty, like I said, I expect a big rally based on historical data for the remainder of the year and probably carrying through April. That's been the return profile that we've seen historically speaking. Heading into an election year, typically into October of election years, things get very ugly because there's a lot of uncertainty. And then there's another big lift at the end of the quarter. Now, from a sort of macro perspective, I believe the Fed is pretty much done raising rates, and I think we're going to start to see rate cuts in 2024, which should be good for growth sectors like discretionary and technology.
Is there anything then that I guess would invalidate the scenario that you're talking about? Is there anything you'd see in the data that would really say, oh, this is a false signal, or this is a signal that just doesn't have the strength behind it? I'm just wondering what would change your outlook from what it sounds pretty optimistic.
It is pretty optimistic. I guess what would change the outlook is the Middle East situation and how much that potentially flares up or calms down. There's always the Russia-Ukraine component. Is Putin dead? Is he not dead? With that news, so there are all these geopolitical events that we can't control. But historically speaking, over 100 years, if you were to pinpoint every fear point on the market, it typically times out with a bottom, and we all know stocks have rallied tremendously over 100 years. So I'm still pretty optimistic.
All right, well, that sounds like a good place to end it. Let's walk away with an optimistic.
Let's be happy. It's time to be happy.
There you go, Jason. It was really a pleasure talking here.
Thank you so much for having me. I appreciate it.
Thank you all for watching.